Hello and welcome to My Finance Teacher. Today is 20th of February 2018. I hope everybody is having a good day. In this video, I want to talk about a long-term potential in gold, and I want to talk about this long-term potential based on the comparison of gold price performance with the performance of the general stock market. So on the chart in front of us, the lower part of the chart is gold price, that's a log scale, and the upper part of the chart is the Dow Jones Industrial Average. The chart goes back over 100 years. So what I want to do with this chart is I want to talk about three time periods when stock market decline can be correlated with an increase in the gold price. And after that, I want to conclude with some potential future scenarios for stock markets as well as the gold price. So firstly, one of the three periods that I want to talk about is this decline in the stock market in early 1930s. At that time, Dow Jones lost nearly 90% of its value. This scale over here is a little bit imprecise, so you can search on the internet. Dow Jones lost about 90% of its value in early 30s. And what happened to gold? Sort of at the similar time with a little bit of a lag. What happened is gold basically tripled in price. The price of gold tripled. Okay, the next period that I want to talk about is that during 1970s, Dow Jones lost about 60% of its value. And at the same time, what happened to gold? Well, with a little bit of a lag, gold price actually increased tenfold. Basically, the price of gold increased 10 times during the same time period. Right, that's very interesting. And more recently, in early 2000s, we don't really see a straight decline in the stock market. What we see here is after the dot-com bubble, Dow Jones lost nearly, like a 40% of its value, regained the losses, and again lost about nearly 50% of its value. If I just connect these two dots, the top of the dot-com bubble with the bottom of the global financial crisis, that sort of gives me this 1.5 decade during which Dow Jones lost about 50% of its value. Although there is a lot of volatility, actually Dow Jones recovered all of the losses after the dot-com bubble. In any case, during this period, sometime during this period, Dow Jones lost nearly 50% of its value. And what happened to gold? Well, again, with a little bit of a lag, gold price actually went from, well, nearly 400 to 1900. That's, again, gold price quadrupled. It increased by a factor of 4. Okay, that's very interesting. So basically, whenever the stock market corrects hard, gold price skyrockets. We sort of see these very, very long-term secular cycles or super cycles, as some call them, in stock market that last for a few decades. And during the declining phases of these cycles, here in 1930s, here in 1970s, and here in early 2000s. So basically that gives us a cycle that lasts for a few decades. That's what, about 4 decades. During the declining phases of those super cycles, gold skyrockets, giving us these super cycles in gold as well. So most interestingly, what's going to happen to gold as well as the stock market going forward? Well, I think there are a couple of scenarios. Scenario A, which I think is slightly less likely than scenario B. Scenario A is we've finished this super cycle in the stock market with this 50% decline. And we're now in a new super cycle, which will last for several decades. So we have a decade or two of upside potential in the stocks, in the stock market, which means there is not that much potential in gold. Gold might be sort of trending upwards ever so slightly, maybe at double the speed of inflation or something like that. That is scenario A, based on the idea that this period between the dot-com bubble and the end of the global financial crisis was the declining phase of the super cycle, and we are now in a new cycle, and we are in the advancing phase of a new super cycle. However, there is another scenario, scenario B, which I think is more likely, and I'll talk about the reasons why it is more likely as well. In scenario B, we have not actually finished this super cycle yet, and we are going to see a more significant crash in the stock market than a 50% correction. For example, in the early 30s, stock market crashed by 90%. In 70s, it declined by 60%. So there is a possibility that we're going to lose more than 50% in the stock markets. And an additional reason for that is that since the global financial crisis, central banks all over the world have printed lots and lots and lots of fiat money, lots and lots of dollars, Japanese yen, and a lot of other currencies. All of that money flowed into the stock markets, leading to overvaluation in the stock markets, leading to very high PE ratios in the stock markets, which is a price earnings ratio. That's a ratio that shows how expensive are the stocks compared to the earnings that companies are generating, and leading to basically overbought conditions on the stock market. So for all of that reasons, I think we're not in an advancing phase of a new cycle. Since we are already overbought, we might be topping within this super cycle quite soon, and we're still due for a very severe correction, very severe crash, probably over 50% correction. At least 60% correction as it happened in 1970s. So, well, this 60% drop is not going to start tomorrow. I don't think it's going to start tomorrow. I don't even think it's going to start for another several months. I think stock markets are going for the last sort of bubble phase, and that will take maybe a year. So a year or two from now, maybe 3 years from now, I think we are due for a very strong correction in the stock markets based on the idea that we are overvalued and the PE ratios are extremely high. So if that scenario is more likely, if that is to happen, what's going to happen to gold, I think, is a lot of the capital is going to flow out of the stock markets and into safer assets, including gold and Bitcoin. And gold is, again, likely to triple or quadruple in price. I think we are very likely to see, well, say $5,000 on the gold price in the next. So if that drop starts, let's say 3 years from now, and as it happened historically, if the rally in gold price starts with a bit of a lag, then say in 4 years from now or so, we might see gold priced at 5,000 per ounce. There is some food for thought for you guys. I would really like to know what is your opinion and which of the scenarios is more likely. So leave your comments. Remember to hit the like and upvote it on Steemit. Thank you for your attention, and I wish you luck in your trades.